Welcome back. Our next guest says he's overweight the Canadian energy sector because of low valuations and increased corporate activity. He joins us with some of his top picks in the sector. He's a familiar face to viewers of BNN Bloomberg, John Zechner, chairman and founder of Zechner Associates. John, it's always good to touch base with you. Thanks a lot for making time for us today. We have seen a liftoff in the price of crude oil. Many of the names in the sector have increased as well. What's your take on the Canadian oil and gas space right now?
Well, you know what it is, Paul? It's more the broadening out of the rally that we've seen. I mean, the fourth quarter of last year sort of got that lift overall in the market. But I mean, most of last year, as you know, was just led by the big tech companies, effectively, the Magnificent Seven and all. And even a little of that started off this year. But we're starting to see a broadening out of the rally, Canada and the U.S. And that means that some of the laggard sectors of last year are starting to finally play catch up from a valuation basis, financials, industrials, and obviously energy. I mean, energy sticks out as exceedingly cheap, and we're talking about companies selling for 3+ times operating cash flow, or 20% free cash flow yields at current strip prices of oil. That's very attractive, especially when a lot of the rest of the market has gotten you could argue somewhat overvalued and certainly pricey on the growth side.
How much has the rally in crude oil had to do it? Directionally, the stocks seem to trade in the same direction as the commodity. Crude oil now trading at $82 and change. That's West Texas Intermediate crude. In the early portion of December, it was at 68.61. So it's gained significantly over that period of time. How important has that been?
Well, that's been absolutely a source of strength, Paul. And there were a lot of worries last year that on growth overall, global growth in particular, and what's that going to do to energy demand? And I think there's a lot of worries that oil demand, energy demand in general was going to be lower, and then prices would sort of drift down to the bottom end of the range. And we saw a little of that. And clearly, economic resilience has been the sort of the story of the day, particularly in the U.S., and that has kept up the demand. And we've seen overseas demand remain relatively resilient. And at the same time, you have continued supply constraints in place. I mean, from what you have from OPEC plus to obviously, geopolitical situations in the Middle East. So, those have tightened supplies. Obviously, what's going on in the Ukraine. So, it's a plethora of activity that is sort of following. Demand didn't drop like they expected. Supply stayed tight. The stocks are cheap, and you've had a broadening of the rally. I mean, if that doesn't explain the move in energy shares, it's I don't know what else could.
The three names you like in the sector are Baytex, Cenovus, and Crescent Point. Why don't we start with Baytex?
Well, I think the three names in general, Betex I just find ridiculously cheap. They did this Ranger Oil acquisition last year, and it was the right time to add oil-levered assets. They diversified the base a little bit more. They've gotten away from that old concept that Betex is only heavy oil. And I'm more inclined to move towards the pure oil producers as well, oil-levered, because I'm less bullish about what's going on the natural gas side. It's still somewhat oversupplied. We still have some transportation issues there. So, and then, we moved out of names like, ARC and Tourmaline and Birchcliff, and sort of more really gone to the heavily oil lever players, and Baytex is right at the top of that list, as well as Cenovus and Crescent Point.
And why don't you talk about Cenovus in particular?
Yeah, of the three, they have more of an issue in the shorter term because some of the downstream activities haven't been as profitable. But when I look at the valuation of Canadian Natural CNQ, I mean, that's been the leader in the sector, and it's got such a premium valuation because of its size and liquidity. I mean, Cenovus isn't far behind that. And in terms of long-lived assets as well, given it's mostly oil sands, you're talking about decades and decades of reserves where all the capital expenditures have already been done. So you're only looking at the operating costs on that basis.
A big part of the story, and we'll get to Crescent Point in just a second, but a big point of the sector across the sector, and I think viewers know this, it's not new news, but it's companies being more disciplined with their balance sheets, paying down debt, and once they reduce debt levels to certain targets, returning large proportions of their free cash flow to shareholders, in some cases 100%. Is the market at large coming to appreciate this now?
Oh, absolutely. I mean, that has been a big story of the past couple of years. When I look at like the 80s and 90s, I remember the big knock against oil companies was, for every dollar in cash flow, if you put in $1.50 back in the ground, and what sort of business was that ultimately, as long as you could continue to tap the equity markets for all the money you needed, and all you got was more and more dilution. And there was a real reversal the past couple of years. I realized we've got to be more shareholder friendly. Growth for the sake of growth isn't as important as the quality and returning the cash or the basically the proceeds to the shareholder. So you're right. I mean, paying down the debt, and once the debt gets paid down to a level of maybe 1.5 times operating cash flow, then you can buy back your own stock. Obviously, debt gets paid down, and then you can also increase dividends. And there's lots of excess cash flow to be doing that now. So that's just a little putting on top of the story there. So
okay, I haven't left much time for Crescent Point, but why don't you give us a quick view of your views on Crescent Point?
It's migrated nicely from a Bakken play in South Saskatchewan, Montana, to sort of play in the Duvernay and Montney regions, Montney regions of Alberta and BC, much higher yields in those properties. So they've done a real good transition on the company. Now, obviously, they have done some acquisitions. I think the acquisitions, will sort of fare them well because they're the newer zones where higher productivity wells are. And they've gotten away from this idea of just growth for the sake of growth. They were the biggest diluter of capital for almost a decade there, and that was reflected on the share price, which went from I think in the high 40s to as low as down to $1 or $2. So